This is Quent Bila with comments about Chapter 8, Fraud, Internal Control, and Cash. This chapter covers a number of topics, and this first talk will only cover objectives 1 through 5, stopping after an explanation of how a petty cash fund operates. The remaining 3 topics about bank accounts and bank reconciliations will be the subject of a separate discussion. Again, we'll just be covering the first couple of boxes here: fraud and internal control in general, and cash controls, specifically involving the use of a petty cash fund. The control features of a bank and how cash is reported will not be covered in this narrative. First, a definition of fraud: any dishonest act by an employee that results in personal benefit to the employee at the cost to the employer. 3 factors contribute to fraudulent activity. In other words, what motivates a person to engage in fraud. Generally, there's some financial pressure. There's an opportunity to perpetrate a fraud, and the person doing this rationalizes or the reason why they should do this. And once you come to the conclusion that it's rationalized, they'll generally attempt to pull it off if they feel they will not be detected. The chapter begins with a discussion of the Sarbanes-Oxley Act, sometimes known as the SOX Act. 2 congressmen who sponsored it. The law was passed in 2002 after there were a string of corporate financial scandals, as noted, most notably the collapse of Enron and WorldCom. Enron was engaged in irregular accounting, including embezzlement of funds. WorldCom had a lot of profit reversals, and they booked many expenses as assets. They're both debits, so they overstated income and made a very unusual loan to a CEO. The upshot was that Congress passed this act to require that a system of internal control be maintained by all publicly traded U.S. corporations. Here's a definition of internal control. It's all measures and procedures adopted to 1, safeguard assets, enhance the accuracy and reliability of accounting records, increase efficiency of operations, and ensure compliance with laws and regulations. It's not particularly easy to describe internal control or how poor internal control can lead to problems for business, but this chapter will use cash, main current asset, to illustrate weaknesses. Why? Because cash is most susceptible to misappropriation. As you read this chapter, I want you to note the 5 components of internal control, mainly component number 3, entitled Control Activities, that attempt to reduce fraud. This chapter will focus on 6 principles of control activities that can minimize fraud in any organization. Here's the 5 primary components. The control environment, it all starts with the top, how management sets the tone. Secondly, risk assessment. It's management identifying factors that create risk. Here's the 3rd component that I want to concentrate on: control activities. These are the activities designed to reduce fraud. Number 4, information communication. That means organizations should let people know that good internal control is important and how it functions in an organization. And lastly, monitoring to maintain adequacy. Things change all the time in organizations. Procedures must be updated. They must be monitored to ensure that they're doing that which management intended them to do. Again, the focus of this chapter will be on the control activities that are designed to minimize fraud. Here's the 6 control activities discussed in this chapter. 1, establishment of responsibility. That is, control is most effective when only one person is responsible for a given task. Secondly, segregation of duties. This is very important. Related duties should not be assigned or should be assigned to different individuals. That is, the physical or custodial access of an asset and access to the books making journal entries affecting that asset, that should not be combined. That's a very poor combination. Give someone access to incoming cash and the ability to make journal entries that affects cash in the general ledger. That's setting yourself up for fraudulent practices. Documentation procedures. Every organization should document how what procedures exist and how they are carried out in an organization. For example, companies should use pre-numbered documents for key documents that should be accounted for to prevent unauthorized use. For example, there may be a document that authorizes movement of assets off the company premises. Those documents should be protected. Not everyone should have access to them. This slide shows various physical controls, such as a vault or locked warehouses, etc. Important in any organization. 5, control activity is independent internal verification. This refers to records that can be periodically verified by an employee who is independent, not part of a certain process. Can it be checked by someone? Can someone check, for instance, the deposit of cash each day back to sales records? Someone checking it other than the person that actually makes the deposit. And a 6th control activity, human resources, talking about bonding employees, for instance. That means obtaining insurance, protecting against theft by employees. Employee have a background that lends himself to the activities being assigned in the company. Rotating duties, requiring vacations. Simply requiring vacations is a part of internal control. Some people may never want to take vacations. They may be covering something up. If they leave the office for several weeks, someone may detect some fraudulent activities that they're involved in. There is a limitation on internal control. As indicated, the cost should not exceed the benefits. It should be noted that there is no absolute assurance that all fraud can be prevented or detected. And so there's a trade-off between the measures and procedures put in place and the cost of maintaining those measures. As indicated, collusion can reduce the effectiveness of any system. What's collusion? 2 employees plotting to overcome some procedures, protections in the company. That collusion is very difficult to overcome. This is an illustration of certain controls over incoming cash receipts. For example, you establish responsibility, who's authorized to handle cash receipts to begin with. Secondly, the segregation of duties means that the person handling cash should not have access to making journal entries that affect that account in the general ledger. And all procedures should be documented. If there are certain forms that must be used, they must all be accounted for, etc. The independent internal verification control here, as mentioned, can someone else not involved in a particular activity double check the actions of another person? That's a very important internal control feature. This slide is an illustration of the principle of segregation with respect to incoming cash receipts. And I want you to note how many different persons are involved in this transaction. First of all, the clerk who receives the cash rings it up. They eventually send the cash to a person who prepares a deposit slip, separate person. And that person then actually deposits the cash, sending a copy of the deposit slip to another person in the accounting department. We have the supervisor removing the check register tape, delivering it to the accounting department. And at that point, the independent person in the accounting department can double check that the deposit was actually received by the bank and compare it to the cash register tape to ensure they agree. If they don't agree, there's an issue that has to be traced back. But anyway, I want you to pay attention to that. There's several people involved here. The segregating the actual physical control of cash, who touches it, who deposits it, versus who records the cash, debit cash, credit cash sales, let's say, in the ledger. Separate people to ensure that there are no errors or no fraud is occurring. This just comments on incoming cash by mail, that such receipts should be opened by two people, a list prepared immediately, a copy sent to the cashier's department along with the checks coming in, and a separate copy is sent to the accounting department so they can ensure that deposits are made for incoming cash on a daily basis. So we have, again, a segregation of duties between those who touch the cash, those who actually will deposit it, versus the last person who can double check to ensure that everything is accounted for properly. Review question. Permitting only designated personnel to handle cash receipts is an application of the principle of. The answer is establishment of responsibility. Another question. The custodian of a company asset like cash should not have access to the accounting records. This would be the segregation of duties principle. Now, the payment of bills, cash disbursements, is best done when companies pay by check rather than by cash. And the chapter talks about two systems here, a voucher system and a petty cash fund. The petty cash fund is the actual use of cash to pay minor expenditures. The voucher system is a process that ensures before disbursement is made by check that it's properly supported and all authorizations exist before a check is cut to a vendor. We'll come back to the petty cash fund at the end of this talk to see exactly how that operates. In making payments by check, we see there are similar segregation of duties here. People involved in preparing the check should not be able to sign them or have access to plates that would automatically stamp a signature on a check. Generally speaking, the treasurer's office in a small company would sign checks, not the department preparing them. Here's also an example of using pre-numbered checks to ensure that no blank checks are stolen and used by someone that should not have access to them. If a sequential check number is missing, there'd be an immediate investigation as to where it is, and there may be a stop payment put on it by the bank so it's not used in an unauthorized manner. Once invoices are paid by check, the invoice should be marked paid in a manual system. That'd be physically marked paid or perforated by a machine indicating that the bill is paid, so it couldn't be used a second time to inadvertently or fraudulently pay it twice. An example of independent internal verification on cash disbursements would be that check amounts can be compared to invoices to ensure they agree, and secondly, and very importantly, that the bank statement is reconciled monthly by a person that is not responsible for paying bills. That independence is necessary to check on whether one person is controlling too much of a given process. Also illustrated is that physical controls, blank checks should be stored and not available to persons that are not responsible for the preparation of checks. Question: the use of pre-numbered checks in dispersing cash is an application of which principle? Documentation of procedures. If manual checks are used, they should be pre-numbered to ensure that it's known whether a check was intentionally taken out of sequence to be used by someone else who's not authorized to prepare checks for the company. Any cash disbursement system begins with an authorization to incur a cost or expense in the first place, and it ends up eventually with the issuance of a check to discharge that liability. So a voucher is an authorization form prepared for each expenditure to ensure that they are proper and appropriate. An example here would be, before a payment is made, was there a purchase order issued by an independent buyer? Secondly, is there a receiving report indicating that the goods were received as sent by the vendor? Note that there should be separate parties for each activity. The buyer should not be the person that receives goods in. Also, are the quantities received, do they match the quantities that are billed? Do unit prices on the invoice match the unit prices that the buyer issued the purchase order to begin with? This is an example of a voucher system that compares all these things before a check is released for payment. Failure to have agreement on an item here would result in a check not being sent to a vendor. Okay, let's view how a petty cash fund is operated. Again, these are only used to pay small amounts. Major disbursements or normal disbursements are made by check, but small disbursements can be made by a petty cash fund. 3 steps. 1, first to establish the fund. Second, making payments from it by the custodian, reimbursing employees. And lastly, replenishing the fund. That is, ensuring the custodian has the right amount of currency in the fund to move forward through the cycle again. Now, as noted, journal entries are prepared only when a check is made out to the petty cashier. That is steps 1 and 3 above only, not step 2. We'll use this illustration. Laird Company decides to establish a $100 petty cash fund on March 1st. Okay, this is step 1. What's the journal entry? Debit petty cash, credit general cash. Here we have an example of a check being made out to the petty cash custodian, the amount of $100. The custodian will take the check and cash it and is responsible then for that amount. So we've reclassed general cash with a credit into a petty cash account on the general ledger. That's the control amount. As mentioned, the value of the fund is $100 here, and the petty cashier is responsible for maintaining security of that amount. If the petty cash fund amount is never changed, that is, its size never changes, there will be no more entries to that particular account. It stays on the ledger with that fixed amount. Even when the petty cashier disperses funds from the amount, the value stays the same on the ledger, the petty cash ledger amount. Step 2, the custodian makes an actual payment for the petty cash fund. Here the custodian is using cash from the fund to reimburse employees for approved expenditures. It's paying out cash to the employee and replaces that cash with a receipt from the employee, a bill that's turned over that evidences the reason for payment. In this step 2, no journal entries are made on the books. The petty cashier is not engaging itself with the company, but only with the employee. No journal entries made. As noted, this step here is only an exchange between the custodian and the employee that's obtaining reimbursement from the petty cash custodian. No entries made on the books for these transactions. Step 3, the petty cash custodian requests a reimbursement or a replenishment check rather for $87. The fund only contains $13 and the petty cashier wants replenishment back to $100. What's in the fund? The cash amount, $13 remaining, plus receipts totaling $87. So the general journal entry to record this replenishment check to the custodian is as follows. Debit postage expense, $44. Debit freight out, $38. Debit miscellaneous expense, $5. Here is where the expenses are recorded when the custodian asks for replenishment of the fund. Not previously when monies were paid to employees, but only when the cashier wants replenishment. A check is written out, $87. Again, to the petty cash custodian, they cash it, and at that point their fund now has $100 of currency back to its original state. Note that this replenishment out of general cash does not affect the petty cash account in the ledger. Its original value remains unchanged throughout this process. Just to revisit that step 3, I want you to note this. Before the custodian requests replenishment, on March 15th, the composition of the actual petty cash fund was $13 remaining cash left or currency, plus $87 of receipts. So in total, between the currency on hand and the receipts in the fund, it equaled the fund value of $100. This is what the petty cash custodian is responsible for, to ensuring that that fund value always equals the fixed amount on the ledger. Combination of cash on hand plus receipts for previous cash paid out to employees. Again, that's the value on the general ledger. Petty cash, $100, remains unchanged throughout this process. In this example here, we're going to introduce an error in the process. The petty cash custodian has $12 left in the fund, which means they need $88 to get back to $100 total currency, total cash. However, they still have the only original 3 disbursements totaling $87. The postage, the freight out, and miscellaneous expense totals $87, but they need $88 to get back there. So the custodian has made a mistake. They've given out $1 more than they have in receipts. Let's see how this is recorded in the ledger. First, we record all the expenses from the receipts on hand, totaling $87. However, $1 more is needed. The cashier was short in maintaining the fund, and so we're going to introduce a new account called Cash Over and Short and debit it for $1. Additional $1 expense, that's an undocumented expense due to the error of the petty cashier. So the total check amount is $88. That's what brings them back to $100 in total. So we have $88 of expenses recorded, $87 which are supported by receipts, $1 which is not supported by receipts. Now, as a reminder, the petty cash account is only used when the fund is initially established. It never changes in value. It remains static on the balance sheet. Now, it could only change in value if the company desired to increase or decrease the size of the fund. In our examples, we had no change in the fund value once established. So this is a static value in the balance sheet. It means it represents the actual currency in the fund at any time, plus any receipts still held by the petty cashier prior to asking for replenishment of his fund. So to recap, petty cash account, it's only used when establishing the fund and becomes a fixed amount on the balance sheet. When replenishing the currency amount, that's when expenses are recorded. Again, the petty cash account does not come into play in that journal entry. Expenses are debited and the general cash account is credited as a replenishing check is issued to the custodian. The petty cash funds are established and replenished by writing regular checks to that custodian. The cash over and short account is used when there's a discrepancy in the fund. That is, the combination of cash on hand and receipts do not equal the total value of the fund. The cash over and short account can be used in either a debit or credit entry, whatever needed to balance the entry when a replenishment is made to the custodian. All the receipts are turned over, they're expensed, and if there is a discrepancy, the cash over and short account is used. If it's a debit balance, it's an additional expense. If it's a credit, it's a miscellaneous revenue in the ledger. Review question. When is the petty cash account actually used in a journal entry? Answer D, when the fund is initially established. Another question, is a journal entry made when the custodian actually disperses funds to an employee? Response C, no. This is not a transaction between the custodian and the company, but between the custodian and the employee. No expense is recorded until that custodian turns the receipts over to replenish their account. That's when expenses are recorded, when another check is issued to the custodian. Expenses are only booked when the custodian needs a replenishment of currency from the company. We've got bank recons in a separate narrative.